Are you looking to take the next step toward investing in commercial real estate but don't know where to go? CRE Central offers a comprehensive education and coaching platform designed to help you get started. Our online courses cover a wide range of topics, from the fundamentals to advanced strategies, ensuring you have the knowledge and skills needed to thrive in this competitive industry. As a member, you'll gain access to our exclusive online community and monthly group coaching calls, providing you with valuable networking opportunities and personalized guidance from experienced professionals. Whether you're a beginner or looking to take your career to the next level, CRE Central has the resources you need. Visit www.crecentral.com to learn more. Welcome back to the Commercial Real Estate Investor Podcast. We are live with another Investors Roundtable today, diving into finding and analyzing profitable commercial real estate deals. Excited for this discussion. Logan and Matt and I are going to dive into identifying market opportunities, analyzing risk versus reward, and we'll dive into risk-adjusted returns. I think that's a very important term for any investor to keep in mind as they're going through this process. And then, of course, building a pipeline of these deals. Because if you have a pipeline of deals to look at, if you've got 5 deals to look at, you're not going to know if any of those 5 are a good deal. But if you've got 100, chances are good you're going to figure it out pretty quick. So let's go ahead and dive on in. Logan, I'm going to kick it off with you first, man. Question of the day. Got to ask the audience. Question of the day. Want to know what you guys have going on. What's the most important factor that you consider when evaluating new commercial real estate deals? Is it population growth? Is it average annual incomes? Is it, traffic counts? What do you look for when you're investing in commercial real estate? Drop it in the comments. Let us know. Logan, what's your go-to method for identifying emerging markets? I know you do a lot in Kansas City, but if you were going to go into a submarket of Kansas City that you haven't invested in, or a new city altogether, what are you looking for that denotes high potential?
Yeah. Well, I think I'm going to take this from an angle that maybe people haven't heard before, right? Because we could talk about, all the traditional ways that people look at this. But, I have been studying how historically cities have been built and what drives that, right? And what drives the new growth at a high level. If I was moving to a new city, I would pull up, let's just say Zillow, and I would look at where properties are selling, and they're selling fast, right? And so that would be my first indicator. Like, is this neighborhood in this location has a days on the market of 30. Everywhere else is 45 to 60. Well, why is that? Okay. And so that'd be my start. But if I'm looking, that's from a residential standpoint. If I'm looking from a commercial standpoint, I'm tracking how public infrastructure projects such as new highways, public transit, expansions, large-scale development plans, because those often signal potential growth areas. For example, I know in Kansas City right now that the city manager has been focused on these 8 projects that over the next 6 months will break ground, and it's about $2.5 billion of new development, and that is a partnership with public and private money, utilizing the Port Authority here in Kansas City. So I would start with trying to understand that, and that's the importance of tracking city council meetings, zoning changes, urban and suburban planning initiatives to stay ahead of these infrastructure developments. Because if you are a landowner, a property owner, and you buy property around somewhere where there's going to be infrastructure development, right? What's going to happen if that new highway creates your traffic counts from 10,000 vehicles per day to 75,000? You didn't do anything to have to improve your property. The landowner takes all of the gains. So I would highly be focused on that, and understanding that every city has a plan. They have a growth and development plan. Well, how many investors here out of the many folks that are joining us know in their markets, have you got on the Economic Development Council's website? Have you got on the zoning and development website and pulled up their development plan, where they're trying to initiate growth, and figure that out, because that is where public infrastructure is going to go. That's where people are going to start moving. Businesses are going to try to start to get to, and that's going to create opportunities. So that's how I try to look at from pockets of new growth and where I try to focus on from an investment standpoint.
Yeah, I think you're right on the money, right? Because, I mean, if houses are moving quickly, that means population growth is probably trending upwards, right? If it's trending down, houses aren't going to sell very fast. There's nobody to buy them, right? So what are those upstream or even downstream results that are going to be economic indicators for what you want to achieve, right? I think that's brilliant, Matt. We just had a visit from Matt Anderson Jr. Glad he could join us on the podcast. When it comes to, like, okay, over the past couple of years, we've heard office is dead, office is dead, office is dead, right? How do you balance, like, what's going on in your local market compared to the broader economic outlook or concerns? Because those are often two extremely different things.
Yeah, and I personally like to take contrarian approaches as much as I can, because to me that's often an opportunity. But so, I mean, can you hear something in the background here?
Maybe.
Sorry, we had an early release day, and I thought he was covered, but we'll see how this goes. So sorry, guys. But so for me, when people are shouting to stay away from something, I can't help but see if it's an opportunity when it comes to office, for example. And you're right. I think it really is local. Like, at the end of the day, you can talk about office nationally and make some really great points. But I think it's significantly less relevant than what is the local market of the deal you're looking at, right? And so, when I bought my office buildings in Middle Tennessee, we're in a couple markets that are, they're not Class A, they're affordable, they're outside of downtown areas, and so I pay attention to the national trends, but I think I was able to use those to my advantage, right? Everybody's a little bit afraid of office, and we studied, to Logan's point, we're looking at, are there jobs coming in, right? Are there developments happening that's going to bring jobs into the area? What are what's the absorption rate for this sort of asset class in this area? What's the how affordable is the rent that we can get, the conservative low end rent that we can ask for, and what's that compare like to tenants other options, right? And so for me, it really is typically hyper local. Now I'm a little bit more localized in my investments. I mean, everything I do is in Tennessee for the most part. So that's population growth. Looking at average incomes to me is important. Diversity of businesses is important, right? And supply of the asset class and the price point I'm looking at is super important for me. Are other things coming online that are going to be competitive with me, for example? Or am I fairly insulated, right? Am I buying something where I'm pretty confident I've got the demand from the tenants, and I'm pretty confident there's not going to be new competitors coming on, but I'm also confident population's growing and jobs are growing, right? So that's a simple approach. I mean, not anything groundbreaking, of course, but that's a simple approach I like to take when I'm analyzing this on a basic level.
Yeah, I like that. I mean, it's interesting how many different ways you can really start to look at these deals, look at these markets, determine what you should and shouldn't be paying attention to, or what makes a good or a bad market. Because at the end of the day, I think the reason that this is so difficult for a lot of newer investors to grasp is because everybody has their own definition, right? What could be a really good market to me is a horrible market to somebody else, right? I actually had this conversation with my brokers earlier today because I'm on Dickerson Pike. That's an emerging corridor. Well, one of my brokers had an investor that was looking out in Hermitage. And, to me, Hermitage is riskier than Dickerson Pike. I was like, they should look at this deal on Dickerson Pike. And they're like, well, they live out in the suburbs. So actually to them, Dickerson Pike is riskier. I'm like, that's funny because I see it the exact opposite. I would say suburbs is probably more risky because I don't really understand those market metrics as well as somebody that lives there does, right? Makes a lot of sense.
And one thing I forgot to mention that I think is just super important, because you can look at the demographics and all these trends and things of that nature, but something that can give you a huge edge or a huge risk factor or disadvantage is relationships or lack of relationships.
Yeah.
Because the reality of it is, in this business, we're dependent on partners, relationships, third party vendors, right? Property managers, contractors, and so that's a huge factor that you really cannot overlook. It's you can find a great deal in an emerging market, but if you're doing $1 million construction project and you don't have a contractor that you can trust and rely on, that's probably not a good deal for you, right? And that might be a better deal for somebody who lives in that local market who has a great contractor relationship. So that I think that can be a make or break point too, because when we're going into markets, sometimes we're more fixated on that than anything, right? When we moved into Jackson, Tennessee, for example, into multifamily, I called almost every property manager in the area, and I wanted to know who's our plan B and C. Do we feel, and the same thing with the contractors, because in some of these markets, you can have a great emerging market, but if you don't have a key relationship in place, that deal's not a sound deal anymore.
That's right. Yeah, everybody's got their own competitive advantage, right? I mean, Matt being an attorney, you can put these documents together, right? Somebody else being a contractor, they can save 10, 20% on their construction budget, right? There's different advantages that make deals better for other people than it may be for you. Cesar is saying, good afternoon, Tyler. Hate that I missed your Tuesday live stream, but I wanted to ask, what is the current market in Nashville look like for ground leases? Hope all is well. Cesar, thanks for joining us, man. The market in Nashville for ground leases is pretty small. I would say it's probably the same for Kansas City. It's not a big, where Logan is. I don't think it's a very big market in the South. I think once you get to like a bigger city, like maybe in Atlanta, and definitely up in New York City, it's very, very common for you to see ground leases left and right. We'll see them every now and then, but to me, they're just not that attractive because oftentimes the land is cheap enough to where you can buy it and you don't have to worry about it. All right, let's get into analyzing risk versus reward. Logan, when you're looking at a new deal, how do you balance risk versus reward? Because a 7% cash-on-cash return is not always a 7% cash-on-cash return, right? If we're talking about 7% cash-on-cash with a 20-year Walgreens triple net lease versus a 7% cash-on-cash from a local mom and pop, meat and three restaurant, those are two totally different deals.
Yeah. Well, right now, I think that we might be taking the meat and three restaurants.
Yeah, that's right.
Okay, so risk is often one of the most misunderstood aspects of any real estate deal. We define this as anything that is unknown or not a part of the plan. It's your job as the investor to uncover as much information, negative, positive, neutral, that you possibly can. So just saying that something is high risk is incorrect, because a risk that has a high likelihood of occurrence but a small impact may be completely acceptable. On the other hand, a risk with a medium likelihood of occurrence and a high impact can be completely unacceptable. And so there's different types of risks that have to be balanced, right? Which is the first one, feasibility. Is my project, what I'm trying to complete here, the outcome, is it feasible? Meaning from a financial standpoint, but also a usability standpoint. How about any time delays that you have? What about one-time financial costs, recurring financial costs? I mean, everyone is talking about surging insurance prices right now. I mean, this is not baked into anybody's pro formas of 35, 45, 50, 100% increases on their insurance that is required by lenders to have, right? So that is a one-time financial cost that becomes recurring that was not in your business plan, right? And then it's the quality, right? What quality do I have in this project compared to what I'm delivering in the submarket? So that's how I think about those risks. And then I work to try to manage each one of those by understanding the actual risk itself from a quantifiable standpoint. Now, if we could do that successfully, we would be Howard Marks, right, with Oak Tree Management and one of the most successful investors of all time. He's obsessed with risk. Charlie Munger, Warren Buffett, obsessed with risk. Sam Zell, obsessed with risk. And how do all of those investors think about mitigating the risk? One principle: basis. Did they get value on the purchase? Is their basis low enough that if any of these unknown risks come up, they will still be able to manage through? And I think that is extremely important to understand. In 2021 and 2022, that was being avoided at all costs in the marketplace. I think many investors are going back to being value-based investors and trying to figure out, what is my replacement cost? What is the cost right now? And where am I at in regards to my basis? And so I think we'll see a flood of that coming back into the market, and tracking the Green Street Property Price Index and other indexes in the market. We are back to pre-COVID levels on basis. What's different? Financing costs and any type of new supply that's coming in the market. So it's always changing. And that's why you can't put your finger on risk, because it's always changing. And so if you did a deal, if you did a triple net lease deal in Nashville 12 months ago, the risks that were presented to you then versus the risks now are different because of the changing environment. So that's how we think about that. And frankly, if we could figure out how to quantify each one of those, we would be the most successful real estate investors of all time. But that is a part of doing real estate investing, is trying to quantify that risk, and you get better as you go on.
That's right. I mean, we've all heard the phrase, you make your money when you buy real estate, right? And it's true, because even if you don't have to be a sophisticated real estate developer or investor or know how to actually turn a project around to make money on real estate. If you just buy it right, you can flip it the next day, right? If you buy it right, you could screw everything else up. And as long as you hold it for a little bit, you could probably flip it and make a profit, right? I'm not recommending that. But when you buy right, it allows you that luxury that if things really go wrong, you're fine. Matt, Logan just mentioned trying to quantify all of the risk. And there are ways for us to do that to a certain extent through underwriting. So what does your underwriting suite look like? What kind of software do you use? What metrics are you paying attention to? What data and information are you plugging into whatever you're using, calculators, spreadsheets, et cetera?
Yeah, and I am not even remotely like one of the more savvy people when it comes to the underwriting and things like that. I love how much Zell and Buffett and Munger come up on these calls, because this is where I've kind of come up with a lot of my frameworks. Munger, in assessing risk, he talks about inverting the question, right? So you come up with, how does this go? What would I do to screw this deal up? Or how would this deal go wrong, right? Zell always like to talk about what is the worst case scenario? Like, what is my downside? What is the worst possible outcome here? And to me, I don't think there's so many people, in my opinion, that just do not sit down and really think about that. They look at the projected returns and they talk about they're all the optimist side of the deal, right? What could we do? How can we make this work? And so for me, what I do is I look big picture, right? Simple, without getting into the weeds, into the underwriting. How does this deal go wrong? How do I go to zero, or what's the worst case scenario? Is there a way I can ensure that's not going to happen, or make the chances of that happen super slim? And if that worst case scenario were to happen, what would I do? And what would the outcome be? And these are the things I'm thinking about. I'm thinking about that first, because to me, the deal can have all the upside in the world, but if I can't calculate that, and if I can't get an answer on it, then I don't do the deal. And so I think that's where the education comes in, right? And the training and the mentorship and the apprenticeship comes in, because it takes some practice and some learning and some exposure, I think, to be able to do that effectively. And I think you've just got to put in the work to be able to feel confident that you're on the mark on the risk side of things. And from my point of view, most of this is about leverage comes with risk typically, right? And so for me, the name of the game for me in wealth building and buying deals and building wealth is how do I increase my leverage while minimizing my risk at the end of the day, right? A partnership comes with risk, debt comes with risk, hiring out other people comes with risk. So all these things are leverage, and they all come with risk. So that, to me, that's been the key for everything I've done, is how do I get that asymmetric upside? And then once I get the big picture, then I run deep into the numbers. All right, if my assumptions are correct, then what's my and we as far as software goes, to answer that question, we keep it real simple, to be honest with you. We run our own spreadsheets that we're comfortable with. We usually have a few different versions. We've got the most simple version, that's like the napkin math, that if I'm talking to somebody who's not really Excel savvy, they can look at the one page and they can understand it. And then we've got the deeper breakdowns, but we don't really get into super complicated software for the most part, to be honest with you. And so that comes last for us, right? Like for me, that comes last. The risk assessment comes first. The numbers come last. And then I get to decide, okay, I like this deal, but how does it compare? How does the cash flow compare? How does the debt pay down compare? How does the IRR compare? Right? That's the back end. It's not the front end for me.
Yeah, that's how we are. I mean, we're relatively sophisticated, I guess I would say, but we're not so sophisticated that it's confusing, right? I mean, you see some of these spreadsheet jockeys really get in there and they'll spend weeks putting something together. And I'm like, dude, this is all a projection anyway. We don't need to be spending that much time to predict what might happen in 2.5 years. We don't know. What can we control? Does it seem like something we can control? Let's go with it, right? It's kind of de-risking it. Man, I got a good story on this. So talking about de-risking, I exited a syndication that I was the GP of last year. As the GP, you typically put almost nothing into it, right? I put $1,000 into this deal, but I was the one signing on the debt. And we ended up selling it after not even 2 years. It was like 16 months. But it was originally going to be a 10-year hold because it was in an opportunity zone. It was originally going to be a $7 or $8 million note that I was taking on personally because, one, I'm the majority GP. There were a couple other guys that would sign on it, but not much. And it was going to be a lot of construction and a lot of risk. And fortunately, we ended up getting bought out, and I walked away with $400,000. Not a small amount of money, but I started looking at my risk-adjusted return, and I was like, you know what? That was dumb. I could do a lot of other things to make $200,000 a year, right? It was $400K over 2 years. So there's a lot of things that I could do to make $200,000 a year, not raising investor capital, not taking on $8 million worth of debt, not venturing out into the unknown. And so that's why, I ended up changing kind of the way that I approach deals because of a successful deal. I think that's kind of the funny side of that. Because you never know what's going to happen. Hell, I got lucky. Maybe the economy would have gotten worse 12 months earlier, and that would have been a totally different deal. So it's one thing to keep in mind. Like risk-adjusted returns really, 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 really do matter when you're getting into this. So make sure you're underwriting properly. You're taking those numbers into account. Now, Logan, none of that matters, obviously, unless you've got a significant amount of deal flow so that you can actually look at the deals, right? That actually helps you de-risk every investment you do, because if you're looking at more deals, you're not just hoping you find a good one. You've been able to analyze enough to where you say, you know what, I know that this is a good deal. You come from a similar background as me with the brokerage. How do you make sure that you maintain a full pipeline of opportunities that you could invest in?
Yeah. Well, let's take it all the way back to Aristotle. Aristotle is how I learned how to keep my pipeline full. He says there's 3 things that you need to do. Okay. Tell them what you're going to tell them, then tell them what you told them. And every single person that you meet and talk with, you need to be able to tell them what you're going to tell them, and then tell them what you told them. And that was early on in my sales career, was the number one piece of advice that I got. And so most opportunities, one, you should have a brand awareness, putting that out there on the social medias so people know how to find you and what you're focused on. But number 2, every conversation with a vendor, whether that be a contractor, a lender, an attorney, whatever, they say, hey, what are you up to? Well, right now, I'm frankly looking at X, Y, and Z because I'm trying to accomplish this, right? And I'm just telling, and then I ask, right? So I tell them again. So I'm focused on buying or looking for this type of property type. And then, do you have anybody in your network that I could talk with that might either own something or have a listing or have a contact that knows somebody that might own something like that? And so I'm not afraid to ask. And the reason, because I'm giving value typically in most relationships already, right? And so there's the strategies of networking and relationship building and all of those things, and tracking and actually making direct outreach. That's table stakes. It's table stakes. But if you can communicate with someone that you, and with everyone that you're meeting, and you tell them exactly what you're focused on, and you keep it clear, concise, and compelling, people want to help. They want to help solve that problem. And so I try to open up a story loop in their minds to get them trying to solve my problem. Well, the challenge for me right now is really finding great opportunities in this corridor, at this asset class, at this price point. Would you know anyone that I could speak with or make any connections for me? And that is held true to creating pipeline, because like we've mentioned multiple times on this show, is opportunities do not float out there within thin air. They are always connected to somebody. Obviously, being a real estate broker, understanding what's on the market and knowing all those players in the space, very important as well. But they don't know what your problem and what you're trying to solve unless you are going to tell them. So anyways, there's a little lesson from Aristotle today to help you find real estate deals and keep your pipeline full.
I love that. I'm going to go ahead and put it into practice. I'm going to read you guys a comment from Jeff in the live chat. Jeff says, the math has to math, taking emotion out of it. What is my backup plan to my backup plan? What are my exit options? And who am I working with? And am I doing my due diligence on the people as well? My CRE deal taught me all of this. That is what Jeff had to say in his response to question of the day. Practicing a little Aristotle there. I think that's great, Jeff. It was good. It was good seeing you in Nashville this past weekend, by the way, dude. Matt, bring us home, man. How do you stay competitive when you're dealing with these situations, right? Because yes, we want to get the deal, right? We want to make the best offer so that we get the deal, but you also don't want to over offer it, because sometimes you kind of walk away, you're like, man, I was awarded the deal, but is that a bad thing? Right? Like, did I overpay? Am I the idiot here? How do you stay competitive but make sure you're doing it in a risk-adjusted, profitable way as an investor?
Well, that's kind of a paradox of a question for me, because for me, the goal is not to be competitive, right? Like there are some people I don't want to be competing with. There's a lot of offers being made where I don't want to be the best offer because of what the offer is, right? So for me, the way I'd be the most competitive, I guess, would be to understand what I want and what I'm contributing and what value I can have, and then spending the time, whether it's the broker or direct to seller, understanding the seller's needs, understanding the property, understanding the specific opportunity, right? Because most of the best deals I've ever gotten have been when I've been able to understand the seller's problems and offer a solution, a unique solution that I'm confident I can deliver on through rapport, right? So that's kind of a strange, maybe a strange answer to your question, but I don't really want to be competitive. I want to be a unique source of value, right? And so I guess in a sense I'm competitive, but I'm competitive because there's no one else that can do what I can do when I'm making that my focus.
I'm going to steal Logan's thunder right here and jump in with the Blue Ocean Strategy. It is a phenomenal book that you should absolutely read on what Matt just talked about. It's how do you be competitive without having competitors is really what that book is all about. It changed the way that I approached brokerage. The red ocean is where everybody's fighting over scraps. The blood's in the water. The sharks are all swimming around it. How do you go find your blue ocean where you don't have to compete with anybody else? Because what you deliver is so unique. For example, for me, that was opening up my brokerage in East Nashville where no other brokerage firm was. I didn't have to compete with anybody else. So that's my charge to you today. Think through what is the one thing that you can do that puts you above and beyond anybody else. Nobody can compete with you. Thank you all for joining us on this episode of the Investors Roundtable. That was finding and analyzing profitable commercial real estate deals. Hope you guys join us in the next few episodes. Leave us a like, give us a review on Apple Podcasts, and we'll see y'all in the next one. Are you looking to take the next step toward investing in commercial real estate but don't know where to go? CRE Central offers a comprehensive education and coaching platform designed to help you get started. Our online courses cover a wide range of topics, from the fundamentals to advanced strategies, ensuring you have the knowledge and skills needed to thrive in this competitive industry. As a member, you'll gain access to our exclusive online community and monthly group coaching calls, providing you with valuable networking opportunities and personalized guidance from experienced professionals. Whether you're a beginner or looking to take your career to the next level, CRE Central has the resources you need. Visit www.crecentral.com to learn more.